Today, a polarised outlook looms. Bull versus bear. Hello again, it's Martin North from Digital Finance Analytics. Welcome to those posts covering finance and problem news with a distinctively Australian flavour. As I discussed at the weekend, analysts are deeply divided on the future trajectory of markets, some pointing to the risks of a recession ahead and weaker earnings, others highlighting low unemployment and positive market momentum. This polarisation is more extreme than I've seen in recent years, with both scenarios emanating from major investment banks. So today, I wanted to explore this diversion further to consider again whether the US stock market is poised to extend its longest winning streak in the year or will slip back to another false dawn, with knock-on effects across other markets including Australia. But before I start, a quick reminder that if you value the content we produce, please do like the posts and consider subscribing to receive further updates. This really makes a difference to us getting our message out, as views, likes and subscriptions drive the YouTube algo. And a word of thanks to all those who support what we do. Now, this V-shaped rebound has likely caught many investors off guard, and they're unable to capitalise on such an abrupt upward move, especially after the market sharp correction back in June. This rally is often called a lockout rally, essentially when institutions underestimate the turnaround in the stock markets and have to increase their exposure in a short amount of time. These rallies typically end in exhaustion runs, with leading names showing blow-off tops. According to Bloomberg, the S&P 500 market breadth is getting stretched, with the share of index members trading at overnight bought levels surging from 0 to almost a third. And the August Empire State Index, a measure of manufacturing activity in the New York area, unexpectedly fell to minus 31.3 from 11.1, confounding expectations for a reading of 5. This weaker than expected regional manufacturing report added to worries about economic growth, following a slew of data overnight showing that there was a slowdown in China, including industrial production and retail sales. In fact, overnight China unexpectedly cut its one-year medium-term lending facility loans to some financial institutions by 10 basis points, from 2.85% to 2.75%. And in parallel, the People's Bank of China drained liquidity from the local financial system, trying to ease conditions for the desperate, whilst recognising a dip in credit costs won't still generate demand from the masses, said China Beige Book International. China industrial production rose 3.8% year-on-year in July from 3.9% in June, against an expectation of a gain of 4.6%, and retail sales were up 2.7% year-on-year from July from 3.1% in June, and China residential property sales fell 28.6% year-over-year. Oil prices fell around 5%, following fears that China's growth will stall, with the WTI down to 88.38. Yet, markets continue to rally, and so I asked myself, when is the selling going to come? So let's call the bulls up first, as typified by JP Chase, who say the rally, which has pushed up the tech-heavy Nasdaq Index 100 by over 20%, could run through to the end of the year. Is the rebound getting overdone, and should one go back to value style? No, not yet, in our view, JP Morgan strategist wrote. The JP Morgan strategists have remained among the very few top-ranked bullish voices on US stocks this year, even as equities marked their worst first-half rout since 1970. They said that the stock market will rise in the second half of the year, driven by rate-sensitive growth shares that have rallied as bond yields pulled back from their June peak. Any shift back into value stocks would likely wait until signs that US growth has bottomed out, according to those strategists, which they expect to happen in the fourth quarter. Such optimism has become more common among investors since mid-June, after corporate earnings were much better than feared and data showed a slight cooling in runaway inflation. The S&P 500 ended last Friday with its fourth straight week of gains. That's the longest weekly winning streak since November. But on the other hand, Morgan Stanley strategist said in a note on Monday that the sharp rally since June is just a pause in the bear market, predicting that share prices will slide in the second half of the year as profits weaken, interest rates keep rising, and the economy slows. Morgan Stanley strategist Michael Wilson, one of the most vocal and staunch bears on US stocks, said that the rebound is now overdone, citing the risks posed to the economy, tighter monetary policy, and the outlook for corporate profits. The macro policy and earnings setup is much less favourable for equities today, he wrote in his note, adding that disappointing earnings in the next few months could spark the next leg lower in stocks. The risk-reward is unattractive, and this bear market remains incomplete. What's likely to drive the next leg stocks lower? Well, we think the catalyst will end up centering around earnings disappointment. Something else to consider is an end to corporate America's record stock buying spree after a record spree so far this year. Although buyback authorizations have jumped 18% to $856 billion in 2022, actual spending on stock repurchases sank 21% in the second quarter compared to the first, according to data from Goldman Sachs. JP Morgan Chase, Citigroup, and Best Buy all paused buyback plans when reporting their second quarter results, deciding to hold on to cash instead as the Federal Reserve's interest rate hikes drive the economy into recession. They're among the 10 that have halted programs this year for reasons unrelated to M&A, a very, very rare phenomenon, according to Bernani Associates. The moves may be an early sign of a pullback from an era of record stock buybacks that erupted in the wake of the pandemic when executives tapped cash hoards to purchase almost $1 trillion of their own shares. While analysts debate how much impact stock buybacks ultimately have, the retreat threatens to remove one crutch from a fragile market already contending with inflation and the spectre of a global growth slowdown. Buybacks have been the largest source of US equity demand this year and a big support for stock markets, said the head of equity strategy at Julius Baer. But buybacks are expected to slow from here amid a dimmer outlook for earnings and lower CEO confidence. By the end of the first quarter, US firms had spent just over $265 billion on buying back stock, a record amount according to Barclays data. While repurchase announcements have still been strong year to date, some US firms have used the second quarter results to curtail existing buybacks on growth outlook concerns, strategist Emmanuel Kaur said. JP Morgan Chief Executive Officer Jamie Dimon said the bank is taking a hiatus to meet higher capital requirements and to allow flexibility for a broad range of economic environments while reporting earnings that missed estimates. And Citigroup also cited higher capital rules, saying it's now in capital building mode. Other companies are also favouring using cash to bolster their businesses during a tough economic period. Retailer Best Buy said it was pausing repurchases as part of its capital management strategy in response to the current sales environment. The company slashed its guidance and said inflation is pummeling customers. And Starbucks founder Howard Schultz suspended the coffee chain's buyback plans in April, saying the cash could be better spent on stores and staff. So the outlook for buybacks next year is even more uncertain, with a proposed tax on US stock repurchases expected to go into effect. Democrats are hoping that the 1% excise tax will slow the use of corporate buybacks because they produce capital gains but no immediate tax bills. That may open up a window for companies to pull forward their plans into the second half of this year, but strategists don't expect this to provide a big prop to markets, given that overriding macroeconomic uncertainty will outweigh any positive sentiment from accelerated repurchases. Companies with clear guidance will likely try to front-load some of the buybacks, though it may not be as market-moving as some expect, given the major macro drivers at the moment, said Esti Duick, Chief Investment Officer of Flow Bank SA. And Robert Cantwell, Portfolio Management Upholdings Group in Nashville, agreed, "We don't expect a buyback rush in the second half since they are more dependent on share prices than a 1% tax," he said. The tax is more likely to depress share buybacks in favour of more M&A or internal capex. But there's some good news for those looking for a buyback boost. The stock market rebound since its June low may actually reduce companies' need to support their shares through repurchases. Equity market prices have been recovering strongly over the last month, and buybacks should absolutely slow down as a result. Cantwell said, slowing buybacks can be a sign of a strong market as opposed to a weak one. So there you have it. This underscores the highly uncertain outlook for the US stock markets in the face of strong cross currents. On one hand, inflation is showing signs of pulling back from its peak, and businesses have been expanding payrolls at a strong pace, both of which augur well for equities. Yet at the same time, Fed officials have signalled that they will continue to raise interest rates aggressively until consumer prices increases are reined in, which risks driving the economy into recession. The minutes of the Fed's July meeting will be released on Wednesday, and that'll provide investors with another window on how policymakers are thinking about the economy, given the data they're seeing. Some investors believe the recent trend could lead the Fed to get less aggressive with rate increases as it aims for a soft landing, which means cooling the economy without large job losses. Market participants are looking at the Fed saying, hey, they're going to be cutting rates here sooner than we know, and that's going to be good for the equity market, said Paul Nolte, portfolio manager at Kingsview Investment Management in Chicago. This week also brings a slate of data on housing trends, another market that's cooling amid high prices and rising interest rates. So the bottom line is this: it's hard to know whether bulls or bears will win out. I have this nasty feeling that September, October will tell us a lot more, and possibly to the downside. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.